My name is John Geminon, Regional Vice President of Sales here at Angel Oak Mortgage Solutions. I'd like to introduce Gigi. Gigi, please give us a little background.
Good morning, everybody. So my name is Gigi Bronstrup. I'm the Producing Area Sales Manager in the Southern California area for Angel Oak. I've been with Angel Oak a little over 4 years now. My background is extensively in underwriting operations and sales.
Great. We're lucky to have Gigi on our team. Kevin, please introduce yourself.
Hey everybody, I'm Kevin Ward. I work out of the Minnesota market and much of Wisconsin. I've been in the industry overall for about 25 years. I've been with Angel Oak for a little over a year now. And I've been a realtor, I've been a loan officer, I've been a broker, and I've been an AE. So I've kind of got a background in the whole industry. So I know everybody's pain points. I've been around for a while. So I'm looking forward to working with all of you and spending some time with you right now.
Yeah, it's interesting background there, Kevin, and how you know how important all the relationships are in a transaction. So that's awesome that you bring that to the table. So hey, this is a deep product dive. We're not going to talk about what we just recently securitized over $10 billion. We're not going to talk about the 39 securitizations. We're not going to talk about our vertical integration and what that makes us the best and the leader in the industry. We're going to dive right into products. So without any further ado, let's go to our programs. Hopefully everyone can see our website, and we're going to give a highlight of our programs, and we're going to start with bank statement. But before we start with bank statements, we really want to get some feedback from you, our audience here. And the first poll is going to be, how many of you, or who has originated and closed a bank statement program in the last 12 months? And hopefully it's okay. While that's going on, I want to throw out a little statistic here. In 2020, new business applications grew by 24% over 2019. That's the largest increase in new business applications in over 10 years. So this segment of the industry is going to continue to grow for the foreseeable future. And guess what? Those people who signed up for new business applications in January of 2020, they're eligible for our bank statement program today. So the result polls, wow, 77% have not originated and closed a bank statement loan in the last 12 months. And that's what's great about this huge opportunity. And that's what's great about you taking the time out of your day to learn more about the bank statement program. Gigi, give us the highlights of the bank statement program.
Okay, so our bank statement program, we have loans up to $3 million with a minimum loan amount of $150,000. You can use 12 or 24 months business or personal bank statements. This program allows for 2-year seasoning of any foreclosure, short sale, or bankruptcy. Rates are all 30-year fixed rates. We do require 2 years self-employment. Borrowers can own as little as 50% of the business using business bank statements and 25% using personal bank statements. We can do purchase, cash out, or rate term on this program. Owner-occupied, second home, and non-owner. And our non-owner LTVs are up to 85%. There's a 1099 option available as well. There's an interest-only option, which is a 40-year fix with a 10-year IO period. Most of our loans will qualify on a 50% expense ratio. We do allow companies with a lower expense factor to use that, if requiring a third-party or CPA tax preparer letter to confirm the expense ratio. We allow non-warrantable condos, and any loan amount over $1.5 million would require a second appraisal.
Yeah, great. And it's funny, we already have one of our attendees, Mark, is asking how does he get signed up with us. So Gigi, you're already lighted a fire here. I love it. I love it. So hey, Kevin, questions are coming in. Yes, this is being recorded. We've got a lot of people asking that question. So thank you. This is being recorded. We will get this out to you before end of day tomorrow. And if by chance we don't answer all your questions, we will have an AE reach out to you no later than tomorrow morning to get your questions answered. So So Kevin, let's talk a little. First question came in, Kevin, talk about the interest only, because these self-employed borrowers really are cash flow sensitive, right? So talk about how the 40-year fixed interest only works.
So essentially, it's really just an add-on. It's the 30-year fix stays in place, the rate stays in place. You know, you're not having to change anything after the interest-only period is over. But it's a 10-year add-on to the front end of a 30-year fix. You get a quarter-point hit to your rate overall. So if you got a 5% interest rate as an example on a net normal 30-year, you would get a 5.25 rate to have the interest-only option added to it. But you get a full 10 years of the interest-only payments, and they can stop making those payments interest only and go to P&I anytime in that 10-year period if they want to, simply by letting the company know whenever they want to do that. But they get up to 10 years of interest only payments. If you think about from a cash flow standpoint, if you're looking at building your business, or if you're wanting to buy an investment property, and you want to maximize your cash flow in a period of time up to 10 years so that you have more money to work with for whatever you need to use the money for, it's a fantastic option. And on the investor side, we see that used all the time, whether it's on this product, on bank statement loans, or on other products we're about to talk about. It's a great way to increase your monthly cash flow just by doing a quick little add-on, and it literally doesn't change anything else about your DTI or your qualification.
Yeah, so Kevin hit on a point there, and Stephanie, hopefully you caught that. Stephanie wants to know if we're going to be talking about DSCR, or Debt Service Coverage Program. Stephanie, we're going to get to that, I promise you. But this is our most popular program, and as I mentioned, that statistic, more and more people are becoming self-employed. That great resignation that's going on in the country, a lot of those people are not leaving the workforce. A lot of those are just starting their own companies.
And John, one other thing,
Yep.
reminder that we go up to 90% LTV on that program with no MI, and the credit scores we start as low as 600.
Yeah, so great point, Gigi. That was one of the questions came up. What's the credit score for a 90% LTV?
For a 90% LTV, the minimum credit score is 700.
Yeah. So guys, we've had, as I mentioned during the intro, we've had almost 40 enhancements in the last 2 years. So things are changing quick. That's why you really need to stay in touch with your account executive. And right now, I would have my non-QM AE on speed dial. If you don't already, I would have that AE on speed dial. I'm going to put on some glasses here and look at what's the max. Kevin, talk about the DTI on the program on the front and on the back, please.
Sure. So all of our loans on the non-QM side are 40-50. So 40% front end, 50% back end. Those are hard stops, but it does give you a lot of flexibility from your DTI standpoint. And we can always, in most cases, unless it's really off, there's a lot of ways we can work with that number to get you under that 40-50 cap.
Yeah. So William, we will show you marketing. We've allocated an hour here, guys. If we go over, that's fine. I don't think Gigi or Kevin, you guys have any plans after this, so hopefully not, right? So if we go over, that's fine. We're going to show you some great tools on how you can get pricing. We're going to show you some great marketing tools on how to grow your business. So let's talk about Gigi, let's talk about the expense ratio. We have a lot of questions coming on expense ratio. I'm going to have Gigi, you're going to have you talk about the business bank statements and talk a little bit business bank statements, and then talk about the expense ratio for business bank statements, please. And then Kevin will get personal on you.
So on business bank statements, what we do when we pre-qual a loan for you, you submit your bank statements to us. We actually send them to our bank statement review team. So they're analyzed up front at the stage of pre-qual. So you know what your income is definitely going to be. It comes back with an automatic 50% expense ratio. Depending on the type of business it is, let's say he's an insurance agent, it's a real estate agent, where the expense ratio is obviously going to be less than 50. We can go down as low as 15%, depending on the type of work that the borrower does.
So a lot of people, again, great. We love the participation. You're asking about, can you get highlights of what Gigi just covered on the bank statement? That's all available on our website, guys and girls. It's available to you. It's angeloakms.com. That's all available, but we're going to take you through all the programs here today. A couple more questions came up regarding interest only, and it is a huge fact. It is interest only for those first 10 years. So it's just basically loan amount, interest rate divided by 12. And it will recast if they do a principal reduction anytime during that 10 years. So just wanted to give you that information. So hopefully that clarifies it for you. Kevin, talk about personal bank statements.
Sure. So essentially from a pricing standpoint, personal bank statements and business bank statements are exactly the same. There's no rate differential. The main difference is if the borrower doesn't really utilize a business bank statement as a source of deposit income, we can use their personal deposit. So a lot of times a realtor as an example, or any other licensed truck driver per se, they might have their deposits go directly into their account. We can use that. We use the exact same expense ratio with one caveat to that, and that is if they also have a business account and they happen to have that account as a secondary account, we'll use 100% of their personal deposits, assuming that their expenses are going to come out of their business account. So it's a good question to ask if you're talking to your borrowers, if they've got a business account, find out how they actually use that account. If most of their money goes into the business account first, that's the one we want. But if they mix it up a little bit, and sometimes deposits go into a personal account and a business account, then we probably want to look at both of those because you might be better off with the personal account. The one thing to keep in mind also is that on a business account, they have to be 50% owner of the company or better. With a personal account, they only have to be 25% owner of the company. So if they have multiple partners, that's something else to keep in mind as well.
Yeah, so, and there's a question on here, what's the difference between 24 and 12? There's a little bit of a pricing difference. So,
yeah.
And Gigi mentioned this about our bank statement review team. Get us 24 months of those bank statements. Let us calculate that income for you, and then we'll direct you on which way you should go, whether it's 12 or 24. So a lot of questions coming in. Hopefully we answered all your interest-only questions. Kevin, a question came in here. Is there a prepayment penalty on the bank statement program?
If it's an investor product in most states, yes. If it's a owner-occupying, there's not. It's no different than conventional loans and otherwise. Now, the one caveat to that, there are some states like Minnesota where I live that you can't have a prepayment penalty on anything under the jumbo amount. So the one that actually changes how we price the loan from the standpoint of borrower paid or lender paid. So if you're in a state like Minnesota where no prepayment penalty is allowed on any product, then we have a different conversation around compensation.
Yep. So, and Gigi, because you're in California, you're seeing those large loan amounts. I know you mentioned it in the highlights. Talk a little bit about the maximum loan amount, and then where our criteria comes in for higher loan amounts and an adjustment to LTV.
So on the matrix, you definitely get a benefit to loan amount. So you get a decrease to your interest rate on any loan over 500,000. It's an eighth between 500 and 750, and it is a quarter from 750 to 2 million. We'll go 90% to $2 million on this program and 80% to $3 million.
Yeah, so Jared, you asked a question about pricing. We're going to show you a really cool tool we have available to you 24/7. We'll get to that. Some other questions coming in. Gigi, give us while you're on the loan amounts and LTVs, give us the criteria. You mentioned 700 score for 90%. What's the next bucket score, and then the buckets below that?
Sure. So again, 700 for 90. We're 660 for 85%, and we are 640 for 75%, and then 600 gets you a maximum LTV of 70.
Yeah, and thank you, Gigi. The prepayment penalty, there's no prepayment penalty, just so everyone knows, and I don't know if Kevin, if you said that, if you did, I missed it. No, there are no prepayment penalties on owner-occupied and second homes. So just want to make sure we clarify that. Kevin, is there a DTI or an LTV change for second homes and investment properties? I know Gigi touched on second homes earlier with the LTV. Kevin, if you want to jump in a little deeper on that, that'd be great.
There is a DTI difference, or I mean LTV difference. There's no DTI difference. We still run 40/50 in all of our products, so that doesn't change whether it's a second home or an investment. Your LTV is going to change based on your credit score and the product. So if it's a second home, there is a LTV hit on that. I don't remember off the top of my head. I believe it's I think you're going to cap out at 85% on that one. But beyond that, it's going to be strictly based on credit score.
Yeah, and I want to bring up, if everyone remembers about, it might have been about 10 months ago that the FHFA instituted some loan level pricing adjustments on second homes and investment properties. They also capped what your portfolio could consist of, no more than 7% for those property types. So those are going to start I think April 1st, they're rolling some of that back out. So, an 85% second home is a great program for a self-employed borrower and to use bank statements. Gigi, we have a question right here. You mentioned the bank statement review team. What's the income we're going to use throughout the entire underwriting process?
The income we're going to use is what comes back on the bank statement review. So once we get that back at the pre-qual stage, you'll know exactly what the 12 and the 24-month average is at that point at a 50% expense ratio. So you'll know if the borrower qualifies right then before the loan's ever submitted.
John, can I jump in real quick? Because this is a really important point on this too, because I get this question all the time is we don't do bank statement loans because it's too much work. Well, we've taken all the work out of it. And I know that in the past that was the case. You don't have to do any work. All you have to do is collect the bank statements from your borrower in a PDF format. And we're going to show you in a little bit on our website how you load it up. It's literally, you take it off your desktop, drag and drop it into our website, and it comes right to us. That's all you do. We do all the work. We have an entire team, 24 hours a day, 7 days a week, that do nothing more than take your bank statements and calculate the income. And that's the income you use for your pre-qual, like Gigi said, and you're done. You don't have to worry about that anymore after that point.
Yeah, Kevin, thank you. That's really a strong statement right there. When you get so Tony's asking here about, do we have a structured desk? These are your structured desks. It's Gigi, it's Kevin, it's one of the 85 to 90 local account executives that we have out there in the field. They're your structured desks. And just to put things in perspective, almost 30% of the loans we close don't meet our guidelines. And you know why? The structured desk that you have and these subject matter experts that we call account executives, they're there to make your deal work. So Tony, hopefully you're working with an account executive, Angel Oak, and they'll be your structured desk. They will act on your behalf and your borrower's behalf. When you get a pre-qual from an Angel Oak account executive, that's as good as gold. And if they're not 100% confident in that, we have another deal desk that will approve, is a second set of eyes, so to speak. So you are not producing a pre-qual letter to your borrower, and then that's not going to work. So you can feel 100% confident. And the landscape is changing, right? Rates are going up, refis are going away. That's why, a lot of you are on this call, double of what we usually get, right? That's why you're on this call. You see the writing on the wall. If you were, 60%, the MBA is saying 62% refis are going to drop in 2022. That's almost 25 or 30% of your income, right? So that's why you're on this call, and that's why you're taking the time out of your day to learn about these programs. And as Kevin said, and I'll be quiet in a minute, but as Kevin said, I think calculating bank statements is easier than calculating tax returns, quite honestly. You could put 10 people in a room and you're going to get 10 different answers on a tax return. So anyway, let's jump back into the Q&A. We're about 20 minutes past the hour. I want to definitely answer as many questions as we can. So hopefully, Tom, that answered your question regarding the income being used. This is being recorded. Want to make sure we understand that. Talk about the transaction types, Gigi. What kind of transaction types do we do on this program?
Are you talking about it within the bank statements? Or
yes.
Rate? Oh.
Yeah.
So rate term, purchase, cash out, investment, including units, up to 4 units.
Perfect. Yeah, and I think it's really strong to drive home that a lot of these, what the heck? I don't know what happened there, but something popped up. Anyway, a lot of these, we're seeing a lot more cash outs come up, right? You know, it's a lot of self-employed borrowers are, you know, wanting to reinvest in their business. So we're seeing a lot more, a great portion of what we do is purchase, but we're starting to see a little bit more cash outs, especially this time of year when it comes to, you know, preparing for your taxes or, you know, paying off all that holiday debt.
And maximum cash out is $1 million.
Yep, that's a great point. Michael, our minimum loan amount is $150,000, and that is a hard stop there. Kevin, can you talk about delayed financing in today's marketplace a little bit?
Yeah, that's really interesting because if you have a borrower, let's say they're an investor, and this is usually where this comes into play. You have a borrower, or even, I guess it could be anybody, in this hot marketplace right now because houses are flying off the market. If they have cash available and they want to buy a house right now that they can't get their hands on otherwise, if they don't put an offer in today, and they have the money to do so, they can go ahead and pay cash for that property. And then sometime from day one after they close, up to 6 months after that point, they can actually refinance that house with us, get rate and term refinance rates, or purchase rates as it were, but get all that cash back up to 80% of the loan to value. So they can, assuming they qualify for a 80% loan to value and their credit score and all that. So they can literally put their money into the deal, buy the property, and then get that money back shortly thereafter and have secured the property that they want to actually get a hold of. And again, today, because of the way the market is and how fast houses are moving, that's a very powerful tool.
DD, question came here, and it is a really powerful. Sorry, Kevin, didn't mean to jump over. DD, talk about reserves. We got a couple questions regarding reserves required for this program.
So our reserve requirement is 6 months on all products. If it's a cash out loan, the cash out can be used as reserves.
Great point. And then Kevin, you know, we're going to wrap it up with just this, you know, talk about the source and seasoning of funds.
Yeah, so essentially we only have a 30-day seasoning on funds for assets that we're using for the closing. So for instance, if they have down payment requirements or reserve requirements, those funds need to be in the accounts and cleared for 30 days. Anything beyond that, they're fine. So it's a very short seasoning time frame.
Yeah, and then Kevin, while you're, let's go Gigi. I just lost my train of thought. Sorry about that. There was a question that came up here. So talk about the turn times, Gigi, from a pre-qual and the bank statement review team, please.
The bank statement review team is usually 1 day, like 24 to 48 hours at the most. Once that pre-qual is completed, you know your income, automatically go to registration and requesting disclosures. From that point, submitting the loan, you've got your loan approval within a week sometimes.
Yeah, and Gigi, one last question with regards to bank statements, because we're 25 minutes past the hour and we need to move on to some of our other programs. But talk about if you have a spouse is self-employed and then the other spouse is W-2'd.
So if you've got a borrower who one spouse is a self-employed borrower and you've got 12 months business bank statements for him or her, and the co-borrowing spouse is a W-2 wage earner, we will use both incomes. We will allow the co-borrower to use the W-2 and the main borrower to use the self-employed bank statement income. It's always based on bank statement pricing though, even if one borrower is W-2.
Yep. So that's great. So, and then I'm going to go one more, Kevin. What if the borrower has multiple bank statements and maybe multiple businesses?
Sure. We can use up to 2 separate businesses, so they can bring in 2 separate business accounts, 12 months for each. The one thing that to keep in mind with that is if there's any crossover, mixing of funds between either accounts, we'll only use one of them. And then we'll kick out the funds that are coming in from the other account. So it can get a little hairy if they are watching funds back and forth between accounts. And in fact, sometimes we run into that with personal accounts as well. So 2 businesses, 2 different accounts, we can use both of those for income, but 2 is the max.
Yep, great. And guys, we're going to move on. I know we can get to a lot of your questions and a lot of great questions, but we will have your account executive reach out to you and answer those questions specifically. So, Kevin, while you're hot, let's move on to the ICF debt service coverage program, please.
Yeah, so like on this particular program, we can go up to.
Kevin, I'm going to interrupt you. I forgot one thing. We do have another poll here. Sorry, guys.
Oh, yeah.
Myself here. Let's launch another poll. We want to see who in the last 12 months has closed a debt service coverage program. And just there's another statistic while everyone's saying if they did or did not. There was a statistic about a year ago that investors were making up 17% of the purchase market out there. And as I mentioned, you know, who knows what's going to happen in April with those loan level pricing adjustments on investment properties and second homes. So really, this is our second most popular program. And we'll get to the highlights here in a minute. The poll results, it's amazing. 84% have not closed we call it DSCR, debt service coverage ratio program in the last 12 months. A lot of opportunity. That's why you're on this call. That's why you're going to need to reach out to your local account executive and get a lot more of your questions answered. But Kevin, give us some highlights here, please.
You bet. Just real quickly off what we just said, I can tell you that at least 30% of the business I'm doing right now is investment cash flow products, this DSCR product. It's crazy right now. So anyway, we can go up to $1.5 million on the loan amount. We do have a minimum on this product of $75,000, so there's a little bit more flexibility there than the bank statement loan. They qualify based entirely and only on the cash flow and their credit. So in this case, if the property, let's say if they're bringing in $1,500 a month, if that's what the market analysis says, because we're going to go off the market analysis from the appraisal. They don't have to have a lease in place. We don't have to prove their rent. We're going off what the appraisal market analysis is. And if they say it's $1,500 a month and their the PITI is $1,500, you're good to go. If it's below that, below that 1-to-1 ratio, we can still do the loan. There just might be an adjustment to rate or price. So just kind of know that in the back of your mind. No DSR is needed at all if their credit score is 700 or higher and they have a max 75 LTV. Guys, this is as close to what like the car industry likes to call a sign and drive. If you have a 75% loan to value and a 700 credit score, your 1003 only has their name and the property information and their assets to prove they have enough for down payment. That's it. No debt information, no job information, nothing else. I don't care. So just keep that in the back of your mind. Properties can be in an LLC's name. We can totally do an LLC. They can't buy it in an LLC. They have to buy it in their name just like any other property, but at title, they can put it into an LLC. If they are refinancing the property, typically we do, and it's already in an LLC, typically they would have to take it out of LLC temporarily at title and then put it back in after closing. Title handles all of that. It's not a problem at all. There's no limit on the number of properties. If you've got 20 properties that you already own, and you know that conventional doesn't do anything more than 10, we don't care. Just so you know, we don't care. We don't factor that in. You can have 50 properties. It doesn't matter. No limits. Or the purchase and cash out is the same. We have no limit on the properties that you currently own. All that's the same. The 4-year fix that we talked about earlier applies to interest only to this product as well. And in the investment world, it's probably 25% of my DSCR loans take this option because they want a cash flow. I mean, think about it. If you've got properties and you want cash flow and you get an option for 10 years, if your goal is not necessarily to own that property outright up front or quickly, and you just want a cash flow property for other uses, why wouldn't you do that? It's huge. Non-warrantable condos are totally fine, and loan amounts greater than $1.5 million, we just need a second appraisal. Keeping in mind that we have a maximum of $1.5 million on DSCR products. If we go above $1.5 million, we have to get an exception.
Perfect. Thank you, Kevin. We'll give you a breath here. And I just want to give a little, Cora, just a comment on the bank statement loan and a shout out to your team. We got an approval the same day, and 2 days later, disclosures went out to the borrower. Thank you, Cora. Appreciate you appreciate you and your business. So thank you. That was regarding bank statement. Gigi, talk about, everyone wants to know prepayment penalties, obviously. So if you could just cover prepayment penalties for us on
I can.
this bank
And
statement.
one more thing on the investor cash flow that is important. Borrower must own a primary residence.
Yes.
Great point. Great point.
Borrower cannot be a renter and buying an investor cash flow loan. So standard prepay is a 3-year prepay or standard 6 months interest on excess of 20% of the original balance. We do offer a 4-year prepay with an 8th benefit to rate. You can buy down the prepay to 2 years, 1 year, or buy out completely, either with rate or cost.
Right. And Kevin, what's the credit score for an 80% LTV on this?
On the DSCR program,
Yes, sir.
you just need a 640.
640. And what will we go down to? Give us kind of the buckets there, Kevin, for lower LTVs and lower scores.
620 and anything below 640 down to 600, you're going to cap out at 70%.
Right. Great. Talk about how many units, Gigi, how many units will we go up to on this program?
We will go up to 4 units. So there's an add-on to rate for anything 2 to 4.
So Kevin, talk about maybe a little bit more about what that Earl needs to look like. Sorry about that. That was a little accent coming out there. Tell us what that needs to look like, Kevin, just with job income and schedule of real estate, please.
Okay. Yeah, I kind of mentioned this real briefly earlier, but on the application for a DSCR loan, all we need is the borrower's name and information. We don't need anything having to do with their job. I don't need income on there. I don't need debt information on there. I do need their assets so that we know they have enough money for down payment and reserves. And we only need reserves for the subject property. So if they've got 5 other properties, I don't need reserves to cover those properties. And then the last thing is, if they have more than one property, obviously they have a primary residence, that needs to be listed. But if they have other investments, we need that listed in the REO section as well. I don't need the income information on those properties. I don't need the insurance information on those properties, but we need those properties listed so that we can cross-reference their credit report. If they have too many properties to put in the REO, just give me a spreadsheet, a rent roll, and that's all we need. We can add that to the file.
Yeah, great stuff. And then Adam is asking here, and I'll answer Adam's question. There are rare occasions where we will make an exception if they don't own a primary, like if they live in a major city and they already own investment properties, Adam, we will work with you, but that's on a case-by-case basis. Again, 30% of the loans we close don't meet our guidelines. So we may be giving you some high-level overviews here and talk, but your AE is your life vest in this business, and we'll separate you from everyone else in this business because they will get deals done that other people are probably saying no to. Talk about the source and seasoning, Gigi, of funds for down payment and closing costs here also, please, and then reserves.
Okay, so reserves again is 6 months on the subject property. Assets have to be seasoned for 30 days and no gift funds allowed on the DSCR program. Has to be borrower's own funds.
And then obviously we'll do purchase, refis, cash outs. Again, you did it so well on the bank statement. Talk about delayed financing again, because I don't think there's a lot of people who really can't hear this enough. Kevin, please.
Sure. Yeah, so again, delayed financing is essentially a way to get your money back on a purchase if you buy the property with cash. For an investor right now, this is really important. So they can use the DSCR program, buy the property initially up front with their cash if they've got money available, own that property. One day after closing, we can go ahead and close on the next one. So while they're prepping to close their current loan or the current property to buy that one, we can already be working on that file to be ready to close that day after they close on their purchase and get their money back. But we have 1 day to 6 months after they close on the purchase of the property to get their money back and essentially a cash out, but it's priced as if it was a purchase or a rate and term.
Yeah, and I think Tom was asking a question here. Let me see if I could find Tom here again. It was really, I think, Tom, I'm not sure if your question was the standard prepayment penalty that Gigi covered. It is a 3-year standard prepayment penalty, but there are options to either go to 4 or even less at a cost or an increase to the rate. Talk about what kind of Kevin, talk about the amount of properties we will allow or our maximum exposure.
Sure.
For this.
So we have some sort of, I like to call them soft boundaries. We don't care how many they own elsewhere. We have a soft boundary on the number of properties they will own, that we'll expose ourselves to per borrower. And that soft boundary starts at 5. Anything over 5 is a sort of case-by-case type of deal. I'm currently working on a deal right now where we're bringing in 10 loans, one borrower all at the same time is buying them as a package, but we have to do each loan separately. And as long as the borrower is strong and we can show that, it's a non-issue. But there is more of a hard cap at the top end as far as the dollar amount, and that's $3 million total exposure to one investor or borrower. Again, anything beyond that, it's a case by case. We just have to go to our exception desk and ask the question to have them look at the file. But those are our caps as they sit in our guidelines. Yeah,
Kevin, we have a Stacy Flanagan, our AE down in the Tampa St. Pete area, did a 10-pack for a borrower and he was doing all cash outs on that. So yep. Again, 5 properties, $2 million in exposure, but work with your account executive. Your account executive is definitely going to be your best friend in this new environment we're all living in, right? So get with your account executive. It's a great borrower and it all makes sense, and the LTVs maybe are lower than what they would qualify. We will get deals done for you, I promise you, and we will close them for you on your behalf. Anything else, Gigi, regarding the debt service coverage ratios that you want to share at all? Maybe what's the score required for less than a 1-to-1 ratio or even no ratio, please?
Right. So on the debt service, we will actually go down to a 0.85 without the hit to rate. You need a minimum FICO of 700 on that. So you actually can go below the 1-to-1 without the rate increase. Anything below the 0.85, we would have a maximum LTV of 75% with an add to rate.
Right. So we can close a property that is not positively cash flowing and still get that deal done. I mean, we're seeing a lot of that because, the rent comp analysis maybe are not catching up with the price of homes these days. So we can close those. All you need is a little bit more down and a 700 credit score. So we're seeing this, and I believe starting April 1st, we're going, or maybe even before, the locks start expiring, or locks are done in March. Before they turn that faucet on in April, we're going to see a run on this program. So really get in touch with your account executive to really work on how to really know and love working with this program. So, Kevin, before we move on to another feature of this investor, anything else regarding debt service coverage ratio?
I think the biggest thing I would like people to get out of this is, number one, the rates on these things are really not bad at all. In fact, in most cases, it's not much more than a quarter point, if it's even that, higher than a bank statement loan, which by itself is not much more than a quarter point to half a point higher than a conventional full doc loan in the first place. So if you got a borrower as an investor and they're looking at properties and they want ease of access, what a great loan to get into. I mean, if they're looking at $300,000 products and the rate's 5.25% as an example, compared to 4.5%, they might be getting through a conventional means for a 3-unit property. Why wouldn't you do this? Because you don't have to produce tax information. You don't have to go through all the nonsense. If they got multiple properties, all that calculation, you just send an application and it's sign and drive. And I'm not kidding when I say sign and drive. If the property appraises and you're good to go, it's a done deal.
Yeah, Kevin, you just hit on a great point. Can't say it any better. Those savvy investors not coming in with 1.5 feet of tax returns and lease agreements, all that. Right. Very well said. So let's talk a little bit, Kevin, about. Oh, sorry. What we recently just added underneath the debt service coverage ratio program.
Sure. So the foreign national program is really interesting. I've had quite a bit of interest over the last even 60 days on this that I hadn't had all last year. And all it is if you're a citizen of somebody other than the U.S., you live in another country, you own a home in another country, but you want to buy an investment property in the U.S., maybe you want to buy a Florida property, whatever the case might be, you can buy a property using the DSCR program because, again, we're not going to ask for proof of income. We're not going to ask for proof of job. We're not even going to look at your credit report on this program because you don't have a U.S.-based credit report. So we're going to essentially follow that same guideline. Same $75,000, same maximum loan amounts of $1.5 million, same ratio qualifications. Everything's the same. The asset sources and seasoning are a little longer. We go 60 days as opposed to 30 days if they're a citizen of the U.S. You need 12-month reserve, 12-month reserves as opposed to 6, and the reserves have to be in a U.S.-based bank. All right, that's really important to know that. So they have to have money in a bank and seasoned for 12 months. They have to have eligible visa, and if they're a citizen of Canada or Mexico, they just have to have a travel visa, passport. No gift funds are allowed, but again, keep in mind, all we season is 60 days, so however the money gets in their account, 60 days later, we don't look at it. So just keep that in the back of your brain. I think it kind of covers, but that's enough. The LTVs are a little different. I think it's a 70% max on foreign national for a purchase and rate and term, and 75 or 65% for a cash out.
Yeah, and Craig asked here, do reserves have to be liquid?
Yeah.
No.
They have to be in a bank account. Yeah, you can't be a 401k. It can't be something else. It has to be cash in a bank.
But I'm talking now, I don't know if that question was for foreign national, but Gigi, just go back to debt service coverage. Do reserves need to be liquid?
Reserves need to be, can be in a 401k, can be stocks, can be in any type of brokerage account.
Yep, thank you. That's what I think Craig wanted to know. Craig, hopefully that does answer your question. So that's a high-level overview of our foreign national program. Again, it fits under our debt service coverage, so it really makes it super, super easy to close these loans. Think of if your business is around a large university, what I've seen in the past, people want to send their children to those universities, so they're purchasing investment properties around larger universities to send their children here. So think, again, outside the box on how to market to these programs. We're going to move on. We're getting close to a quarter of the hour. We're going to have Gigi cover one of our full doc programs. I've got to move a few things around here on my screen. I apologize. Gigi, talk about our platinum program, please.
So our platinum program is one of our full doc options that we have. Loan amounts up to $3 million. Again, the minimum loan amount is $250,000. We do go up to 95% LTV on this program. Again, we have no MI on any of our non-QM products. Credit score starting as low as 660. We do require 4 years seasoning on any foreclosure, short sale, bankruptcy. We do have an option with our Portfolio Select program that will go down lower than those 4-year seasoning requirements. Owner-occupied second home, non-owner, again, purchase cash out rate term. This is a full doc only program, but we do have a 1-year tax return option. We offer the 40-year fixed with interest only as well, non-warrantable condos. Same, anything greater than 1.5 is a second appraisal.
Yeah. So really, this is a full doc. So if they're self-employed, we're not using bank statements, right? This is a full doc program. If they're self-employed, we're using tax returns. If they're W-2, obviously we're using that W-2, but this is a full doc program. And so people might say, well, I'll go the traditional jumbo route, right? Well, Kevin, talk a little bit about the seasoning on foreclosures and why someone maybe can't qualify for that traditional prime jumbo.
Depending on the bank and the investor, most prime jumbos require at least a 4-year seasoning on a foreclosure or an investment property, a foreclosure or a bankruptcy. So we have 2 years as our
on our next program. But what I've seen, Kevin, sorry about that, I've seen on prime jumbos 6 to 7 years.
So I was going to say that was my.
Yeah.
I was going to say my next statement was going to be, I've seen as high as 7 years. So thanks.
Yeah, no, all good. That's why we're three of us on here, right? So, but yeah, that's the reason why you'd probably go to this platinum program, is if you're maybe in that 4 to 7 year window of a credit event in your life. So that's why you would possibly go our platinum program. And again, it is full doc only. And as Gigi said, we do offer a 1 year tax return on that. Kevin, let's talk about our other full doc. Oh, we're gonna. Yeah, I'm sorry. Yeah, Kevin, let's talk about our other full doc program called Portfolio Select.
Yeah, so this is essentially the classic conventional fallout products. So let's say they don't quite qualify for Fannie Freddie products because they added bankruptcy, 3 years ago. And, again, we can go 2 years on our bankruptcy. So in this case, we can go $2.5 million. We have a minimum loan amount on this product of $125. And again, those are pretty much hard stops in most cases. 1 year seasoning on a foreclosure for this. Good luck getting that through a Fannie Freddie filter. 2 year seasoning for bankruptcy. Purchase and cash outs all the same. Owner occupied second homes, investment properties. Those all qualify under this product. 50% debt to income ratio. Again, another fallout thing. So bankruptcies and foreclosures are one, but DTI is a big one. A lot of times you have a high DTI and you can't get through Fannie Freddie. So Portfolio Select comes to the rescue. We do allow to get funds. We can't throw the interest only on it. Maybe they're in a job flexibility type framework and their income's going up, but they need some help right now. Throw in an interest only and let them get some relief on their payments for a while. You can't do that in Fannie Freddie. Again, non-warrantable condos, can't do that with Fannie Freddie. So this is a classic, hey, it doesn't quite fit the box and we have a product for it.
Again, full doc, self-employed borrowers are going to need tax returns. So just so everyone knows that. And we used to, we still do call it a 2-for-1 program. As Kevin said, you get that borrower today in that house, even though they might have had that, 36 months out from a bankruptcy or a foreclosure. Get them in that house today, because we're still seeing appreciation rates. You're probably going to see still high single digits for the next few years. And then once they get that season and further in their rear view mirror, refinance them into a conventional loan at probably a lot easier LTV. So don't say no to that borrower, and don't say no to that referral source. We get, I get at least one call a day from a borrower who has been told no so many times that they go directly to the source here at Angel Oak. And then we'll funnel those leads back out to, our best partners who know how to close non-QM loans. And that's why you guys are on this call today, because there's about 80% of you that responded to the polls that haven't closed a bank statement loan in the last 12 months or a debt service coverage loan in the last 12 months. And I'm sure maybe you haven't even closed, a Portfolio Select or a Platinum program in the last 12 months. So definitely do not say no. These loans are easy to close. Gigi, we're gonna go over one more program here. That's our asset qualifier. If you want to give us some high level view of this, and then we'll move on to some really cool tools.
Okay, so our asset qualifier loan is for borrowers qualifying using liquid assets. Credit score minimum is a 700, up to a 75% loan to value. Again, loans to 3 million. So this is, again, no employment, no income, no DTI. We're qualifying strictly off their liquid assets. We do have a 5-year seasoning requirement for any foreclosure, short sale, or bankruptcy. It is primary residence only, so no second home, no non-owner. Purchase, cash out, or rate term. There is interest only available as well. All assets that we're using must be sourced and seasoned for a minimum of 6 months. So the required assets for this program are going to be the loan amount, the recurring monthly debt multiplied by 60 months, all funds to close, and 6 months of reserves. After all that's calculated, the borrower must have at least $500,000 in post-closing assets.
It's funny. I've seen and I've heard from a lot of account executives lately that they've been seeing a lot more of these programs. So I don't know if it's maybe some of those, that great resignation, maybe some of those people who got nice payouts, maybe, Kevin, I see you nodding your head. Maybe some other things you want to add about certain types of borrowers, maybe if you've seen go for that asset qualifier.
Yeah, you kind of hit it on the head. There's a lot. There's a study done recently by, I think it was Money Magazine, that the Great Resignation is more about people who are like, they're done with their work source and they're just retiring early because they got $3 million sitting in the bank that they've been saving and they don't want to do it for 10 more years and they're 52 years old. So you're seeing a lot more of those people come out of the woodwork. And the thing to keep in mind, Gigi hit on the qualification, how you go about it, how you calculate it. We actually have a little spreadsheet we hand to you. All you do is put in the numbers and it does it for you. It does it in 5 minutes. So you don't have to sit there and try to figure it out yourself. I will, or Gigi will send you a little spreadsheet. You put in the information and it will tell you, it literally gives you a green light that says, yeah, you can do this loan. And if you get that green light, you're good to go.
So, there's a huge boom in tech, right? So you maybe see some companies are going public, right? So they might have a ton of money, but, and maybe they left the company, right? And they're leaving with all this stocks and payouts. We see a lot of that. I know Annie Jensen, who's an account executive up in Washington, has seen a lot of that in her area. You've got maybe someone just had a big settlement from something, whatever it was. We see borrowers like that. We see borrowers that, maybe it was through a divorce that they got a pretty hefty settlement. So the great thing about this program that just recently changed was they used to have to be sourced in season for 12 months. Now we only require 6 months on this. So I am hearing more and more about these loans closing. I think account executive that works with me down in San Antonio, Christy, just recently closed a $1.3 million asset qualifier program. So they're out there. So start thinking about that. Again, we're just trying to, share with you some real life experiences and different things to think about as you go about your day. I know a lot of people have been asking about, rates and this and that and the other thing. So we're going to jump into, I know we're getting close. We're about 6 minutes away from the top of the hour. We're going to jump into one of our best tools we have available to you on our website, and it's our quick quote. Sorry, it's our quick quote, which will turn into a quick call. But we're going to talk about. Sorry, Gigi, give me. I'm going to take Gigi, if you can give me a little scenario here that you want to just cover. Let's do one for bank statements, Gigi, and then we'll do one for the investor cash flow debt service coverage.
Okay, so let's do a loan amount of 1.2 million.
Oh, you're bragging again out there in California.
Let's do a 740 FICO score with a loan to value of 75. And let's go with a purchase, 1 unit. Let's go with 24 months business bank statements, owner occupied.
So this is great stuff. So this tool, Kevin, Gigi, they're available all times a day, but this is 24/7. You don't need any login credentials to get this. This is open to you all the time. So Gigi's scenario was bank statements, LTV 75%. What it's telling you here, if you wanted to, this borrower could qualify for a 90%. And here's a par rate of 4.25. That's a 30-year fix. That is a par rate. So dependent upon, I've had a lot of questions talking about, is everything we do borrower paid? No, not everything we do is borrower paid. We're seeing a lot more people go borrower paid, but we also do lender paid compensation. So you can price into the rate your compensation. So dependent upon your comp plan, let's say your comp plan is 2 lender paid comp, you would add 1 point to that rate at 5.25, 30-year fixed, using bank statements to qualify. That's pretty special. So, and then let's talk about, Gigi, let's do one debt service coverage ratio program.
Okay, so let's do a $750,000 loan with a 720 FICO score.
Oliver loves this tool. Thank you, Oliver. Appreciate that compliment. So
let's do a 75% loan to value. No, how it's what if you want to do units?
Yeah, let's just do a 2 unit. Yep.
Okay, we'll do a 2 unit. Let's do a rate term if you want refi. or we could do cash out if you want to see that. And then DSCR.
Yep, and now it's really critical. I get calls on this every day. Oh, I clicked on a debt service coverage ratio thing. You need to make sure you click that it's an investment home. So based on a $750,000 loan amount, 720 score, 75% LTV, 2-unit rate and term, this is your rate. It's a 5.25 rate, not having to provide tax returns, not having to provide lease agreements on other programs. And yes, it's coming. April 1st, the loan level pricing adjustments are coming to your conventional rates. So you learn this program. I'm telling you.
And John, if you scroll down, they'll be able to see the prepayment information. If they want to buy that out, all the information is below in the pre-qual.
Yeah, this is just, one of the tools, and we're going. I mean, technology is coming fast and furious to the non-QM world, and this is just the tip of the iceberg for you, and a lot of other great things coming down the road. Kevin, let's talk about our marketing portal, and because we are right at about the top of the hour. So you get to our marketing portal, you're going to say, now you have to have login credentials to get here. That's the one thing. You have to be an approved broker with us. So I'm going to log in here, and I'm going to let Kevin talk about some of the great tools we have to help you market yourself. Not Angel Oak, help you market yourself.
Yeah, that's a great point, because what you're going to see on all this marketing material we're about to show you is Angel Oak isn't on any of it. It's all customizable for you to put your names on it, so you're marketing yourself. We're just providing you the tools to do that. So go and scroll down. Let's go right to the flyers. This is a big one. So every product we have has a flyer. There's also a highlights flyer. So if you scroll down a little bit there, John, to the highlights one, just go and click on that one. If you want something to send out to your realtors or your investors or whatever you want to do, this is a great flyer to give them a real high-level overview of what's available that they can provide to them. We're not providing it, they're providing it. Take a look at on the left side of the screen there. You have an option to put in your logo, your photo, and on the right side or the left side, you put in your information on the same left side there. You put in your disclosures there. You save it, and that actually loads up to every flyer that's in the system. So you do it one time, and now you can download that flyer to print out. You can send it out an email, whatever you want to do. So take it with you to go talk to your real estate agents when you walk in. One thing, if you don't mind, I'm gonna take 1 second here.
Yep.
This is something I got picked up from another AE earlier this year. When you walk into a realtor office and you're bringing flyers in and you're talking to these guys, a lot of these guys already have LOs that they're working with, and we get that. What we want you to take from this is those LOs don't have these products. 95% of the loan officers out there don't know what a bank statement is. They don't know what an investor cash flow loan is. They don't have access to any of those. They're only doing conventional. So those relationships they have with the realtor are set based on that. You can talk to these realtors and say, look, I'm not there to replace your guy or gal. I just want to supplement that person. I want to give you something that they don't have. I'm not going to take their business from you. I just want to give you another option so that you have somebody, you don't have to turn down that borrower who's self-employed, makes $1 million a year, but happens to write off all their expenses and can't buy the $1 million house that they want to buy because they don't qualify. So keep that in the back of your mind.
Yeah, that's a great point, Kevin. Then let's talk a little bit about the other great tools we have for them. Let's talk about maybe the social media posts here, Kevin.
Yeah, so the social media, you can literally take these social media posts right here, drop them into your Instagram, drop them on your Facebook page, on your LinkedIn pages, and they're just ways for you to go ahead and easily drag and drop, download, put into your stuff, so that you are showing stuff that you offer to your greater social media audience.
Yeah, and it's really critical. Obviously, rates are going up. Your refi business is in jeopardy, right? So why not think of other ways to grow your business? And we've done the work for you. You do not have to do another thing other than post it. So bank statements, we have them for Instagram and Pinterest and Facebook and LinkedIn for borrowers. Then you can market to those same social media outlets, but to realtors. We've made this so easy for you to grow your business and work with us with, you know, the local account executive, the quick quote tool. So let's talk about one more, which I think, and maybe I'll talk more about it because I think this might be the most powerful.
Oh, this is a good one. Yeah, so this is really important. So there's a flyer associated with this, but I'm going to have you click on the, just do a short presentation, John. Most AEs, myself included, will actually do these with you either via Zoom or in person. These are actual presentations done, made up for you. You put your information on it, customize it however you want to, put new slides in, take slides out, and it's going to come up here in a second. And you can go into a lunch and learn with the realtor group. You can do this online with the realtor group, whatever you want to do. And if you want an AE with you, in a lot of cases, in most cases, I'm imagining, that person will hang out there as a product expert with you and go through this as your support. But we don't have to. You're welcome to do this on your own. And every product, every scenario, every possible way to actually get this across to your realtors and investors in some cases are listed on these presentations. And they're anywhere from, I think, 15 to 30 slides long. And if you want to make it shorter, you can.
Yeah, I think, Kevin, it's really, this is, how great would it be to walk in an office with a Kevin or a Gigi who's a subject matter expert. They don't say anything about Angel Oak. They're just going to say, you know, hey, Joan Smith, who's the loan officer there, I'm just one of Joan's investors. That's it. Joan has access to other investors. I am just one of their investors, and I'm the subject matter expert. And I say this every time, and it happens. If you can get 10 realtors in a room, you will get one of their loans, one of their own personal loans, because guess what? Almost 10% of the bank statement deals we close are for realtors.
Mm-hmm.
That's the stat that we have. You know, that's number 3 on our list. At 10% are realtors. So I know we've run past the top of the hour. Kevin, I'm going to give you a little break here. And guys, just one other thing. This is being recorded. We will get this out to you before end of day tomorrow. And there are a lot of great questions here. We did not, unfortunately, get to all of them. We will get those answered for you. But Gigi, anything in closing that you want to share?
Just one thing that I think we didn't touch on, but we do offer, which is new to us, is our I-10 product.
Yeah.
Yeah. My bad. Gigi's calling me out in front of hundreds of people.
It's okay.
I just want to make sure everybody knows we now have an I-10 product.
Right.
Contact your local AE. They can give you all the details.
Yeah. Yeah, that's a great point. And Gigi, anything else that I missed? No.
No, I think that's it.
Okay, great. Kevin, any final departing words here?
No, I think honestly, just be excited about this because we're still at the front end of the non-QM wave. You know, it's only been in the last year that this is really starting to take off. And I can tell you, I get calls every single day from LOs that I have not even talked to previously or they have ignored me in the past because they were too busy with the agency stuff. Don't be on the back end of this wave because I can tell you there's a ton of business out there where our business is growing exponentially every month right now. So I'm excited to hear from you guys and go get it.
Yeah, Kevin, great point. You know, we took a poll here and it was around 80. I've said this a few times. So thank you for coming on here, but almost 80% of you have not closed, I would safe to say, a non-QM loan in the last 12 months. So there's a huge opportunity out there. You know, unfortunately, you're going to lose that refinance business. I was at a trade show earlier this week, and, you know, it was great to see in person the LOs embracing non-QM and asking a lot of great questions. So I really, for those of you who have closed loans with us, we thank you for your business. We appreciate it. Let us know if there's anything else we could do to help you grow your business. For those of you that have not closed a loan with Angel Oak, please give us a try. I promise you, we will make you look like a superstar. So without anything else, thank you. Everyone have a great afternoon, and thank you for joining us.